The market is officially in correction mode, and that means it's time for investors to start looking at what sort of opportunities there are to buy on the dip. So as we go into April, I put together 6 stocks that I think are really great buys right now. If you're interested in the stocks that I own in the asymmetric portfolio, I'll put a link on the screen and a link in the show notes to asymmetric investing. That's where I'm building portfolios through buys every single month. That asymmetric portfolio outperformed the market in 2024, is still outperforming the market so far in 2025, despite a pretty big pullback from some of the growth stocks that I own. And I'm being really opportunistic in what I'm buying. So those official buys are going to be out on asymmetric investing early on April 1st. And a couple of the stocks here are in that portfolio, even one that I may be buying this month. Before we get there, I do want to thank this video's sponsor, FinChat. You see FinChat charts all over in my videos. This is a research tool that I use constantly. They have everything from transcripts. To presentations to all the SEC fiat filings for over 100,000 companies globally. This is a global platform. Just phenomenal resources, and they make charting really easy so you can look back 10 to 20 years and get data on how a company is trending, what their compound annual growth rate. Got phenomenal key performance indicators. I'm going to go through a couple of those with some of the stocks that I'm covering here. In this video, you're going to get a little preview of what you could get for free for 2 weeks at finchat.io/ASYM. And if you like what you see there, which I think you're going to, you can get 15% off with that link. But let's get to the first stock on the list today. That is Alphabet. Alphabet is a company that I have in the asymmetric portfolio. I'll put a link to the spotlight that I did for them in the show notes below. There's a ton to like about Alphabet stock today. First of all, this is a big tech company that's trading for a phenomenal price. As I'm recording today, the price to earnings multiple is 19. Price to free cash flow is just 26. That's despite the fact that they're spending a ton of money on CapEx for artificial intelligence build out, things for like the Google Cloud. Forward price to earnings multiple is 17. And there's a lot of thought that Alphabet's business is under threat in a lot of different ways, but I don't see that in the numbers or in the way that most people are using their products. The search business continues to grow. In fact, that growth rate has picked up over the past couple of years. There was a blip in their growth when Apple introduced app tracking transparency that kind of broke the tie between clicking on a link on an iOS device and that conversion being recorded by advertisers. But some of the big tech companies like Alphabet have now figured that out, and they're now growing again. Of course, there could be headwinds if we go into some sort of a recession, but this is still a dominant company. And you think about the potential threats to Alphabet's business in search, something like ChatGPT. ChatGPT doesn't monetize well. They don't have an advertising business. They just have a premium business. So if you think about using artificial intelligence in the future, what are users going to demand from that? I think it's going to be similar to search. They're going to demand that these are free tools. And all of these artificial intelligence tools have trended towards free. How do you monetize a business? If it is free to use, you have to monetize with advertising. So Alphabet has a phenomenal infrastructure for advertising. I think that's going to extend very well to artificial intelligence, where, by the way, they have some of the best models in the world today after Gemini 2.5 was released. But let's go through a couple of their other advantages. They have Android and all of the infrastructure that goes in there. So that falls into their subscription and services and hardware segment. That segment continues to grow steadily. On top of that, you have the Google Cloud. That's growing at a compound annual growth rate of about 30% right now. It's also now profitable, operating income positive. You're in that 15% range from an operating margin, but that should increase to between 20 and 30%. So this is a business that's going to get more profitable as it gets bigger. They just acquired Wiz. That could be another growth driver for Google Cloud. And let's not forget, this is the leader in autonomous driving with Waymo. They're doing almost 1 million trips per month at this point and growing that at an extremely rapid rate. I think they could build out a network before any of the other companies actually get autonomous vehicles on the road at scale. So a lot to like about Alphabet. Just keep it simple. Great tech company, great profitability, leader in artificial intelligence, leader in the cloud, and a leader in autonomous driving. And you're getting a great price at under 20 times earnings. The second one is another one I own in the asymmetric portfolio. Again, I'll put that link to their spotlight article in the show notes, but that's MGM Resorts. MGM Resorts owns about half of the Las Vegas Strip, or actually operates about half the Las Vegas Strip. Their real estate was actually sold to a REIT a handful of years ago. So this is just the operating company, and they have phenomenal cash flow coming from the Las Vegas Strip. There are 2 resorts that they own in Macau. They also have regional properties, and they're building a property in Japan. They have a 40% stake in that property in Japan. That's going to be the only casino in Japan. We don't know exactly what the economics are going to look like when that property opens up in 2030, but I think it could be more profitable than Marina Bay Sands, which generates about $2 billion in adjusted EBITDA, proxy for cash flow, each year. So just think about that. Their 40% stake in that resort could be worth about $800 million to $1 billion per year. There is an investment that goes into that, but that's just going to be a few $1 billion for MGM. So I think that could be a phenomenal investment and a growth driver for both revenue and a growth driver for the company long term. In the meantime, management is using a very cheap stock to just buy back shares at a really rapid rate. They're buying back shares at about 15% per year. And after the recent drop in shares, as I'm recording, shares are trading about $30 per share. They could buy back 15 to 20% of shares outstanding and get really aggressive with that. That's going to help the cash flow per share, the earnings per share. So this is a buyback story short term, but long term, it's a growth story with the growth of the Las Vegas Strip, of Macau, of Japan, and let's not forget their digital business. They have a 50% stake in BetMGM in the US. They also own Leo Vegas, which has a bunch of properties all around the world. And most of that is going to be under that same BetMGM branding. Management thinks that digital business is going to turn adjusted EBITDA or cash flow positive this year, not anticipating there's going to be much investment. But that's over $2 billion in revenue from that business right now. So it's already starting to scale. A lot of upside potential, and the price is just too good to pass up. Despite the fact that this is a company you would usually look at non-traditional metrics like adjusted EBITDA because CapEx and depreciation is such a big deal. But even traditional metrics, price earnings multiple right now is about 13, same price to earnings multiple on a forward basis. And that's including that depreciation or rent cost. So I think a lot to like about MGM's business. Yes, it's going to be impacted if there is some sort of pullback in the economy, but so is almost every business. And the operating leverage that they have means that they're probably still going to be free cash flow positive, could still buy back stock, a lot of flexibility for them. Love the valuation and that growth potential if you have a long-term view like I do. Number 3 is General Motors. A lot of talk about General Motors and the impact of tariffs over the past couple of weeks. And the stock has taken a huge hit as well, down to about $47 per share. Market cap of the company is about $46 billion as I record. But their cash flow, their free cash flow is hovering right around $10 billion. That means that their price to free cash flow is going to be 4 to 5 times. Yes, that may take a little bit of a hit in 2025 if tariffs have some sort of impact. But I think the real story here is where GM is making their money is in big trucks and big SUVs. That's still where the margin is in the auto business. They are continuing to grow in that segment, and most of those vehicles are made in the US. So those high margin vehicles still going to be very profitable for General Motors. They are growing in electric vehicles. It's not a profitable business for them yet, but they are the number 2 market share. So if that is an area where you still continue to get a bunch of subsidies from the US government, I think that could be another tailwind for General Motors, especially if Tesla continues to lose market share like we've seen early in 2025. But the real story for GM is just buybacks. They're buying back about 20% of their shares outstanding. This is a theme you have with the last 2 stocks, MGM and GM. They are able to buy back stocks so aggressively, and any weakness in the market. So if we go through some sort of a pullback, some sort of a recession, they are going to use their really solid balance sheets to be able to buy back even more of that stock, come out of that even stronger. So that's why I take the long-term view on these companies that have cash flow coming in the door and have relatively cheap stocks. If the stock continues to fall, management can just buy back stock and get really aggressive there, return that cash to shareholders, and that gives you more leverage in the future as the business recovers. I think GM is a much better and more stable business than a lot of people think. Their core auto business has a net cash position. Most of their debt is held in that financing arm. So that's like a bank holding debt. You would expect that that's what they're going to do. But they're very efficiently run. I don't think the transition to EVs is going to be as fast as a lot of people think. And they now have a clear strategy in autonomy. After they acquired their cruise division, they're going to fold that into their personal vehicles. It could be a long-term growth driver as well as they try to sell that through relatively low-cost subscription model. So I like where GM is going today. The 4th stock is a company that's been beaten up despite some pretty good operating results. That is Coinbase. Coinbase's shares are down about 50% from their high. Market cap as I'm recording is about $44 billion, but that makes this a really good price for investors. The company had total revenue of $6.3 billion in 2024, so that price to sales multiple is below 10. Not a lot of high growth companies that you're going to get at below 10 times sales, and their net income, $2.6 billion last year. That means that the price earnings multiple is only about 18, even on a forward basis. PE ratio is about 22. And the momentum that I'm seeing with Coinbase is not just in trading. Trading is the thing that's going to get a lot of attention, and the down market in the crypto market is really what investors are looking at short term. The long-term story is all the infrastructure that they're building, in particular stable coins, and the stablecoin revenue that they have from the USDC token is a long-term growth driver. I think this is ultimately going to be one of the big revolutions from the blockchain over the next decade or two. It's just a more efficient way to move money around than it is in the traditional financial ecosystem, whether you're looking at wire transfers, sending checks, money orders. All those things are going to be more costly and less efficient than using the blockchain. And stablecoins and the USDC token is going to be a great way to do that. The way that they make money is assets back the USDC token. So bank accounts, treasuries, that money is earning interest, and that interest makes its way back to Coinbase through their ownership stake or their revenue share in the USDC token, which is run by Circle, a company that they have now an equity investment in. So a lot of tailwinds behind stablecoins and all of the other non-trading revenue sources for Coinbase. That's not going to change even if the crypto market pulls back a little bit. I don't think the future of Coinbase's business is going to be the number go up, number go down trading that they have been known for over the last decade. I think it's going to be much more like an AWS or a JP Morgan of the blockchain. I think that's really their future. That's the vision for Brian Armstrong, is to update the financial system. If they're able to do that, this could be $1 trillion company. Right now, we're getting it for less than $50 billion. So if they get to $1 trillion, that's 20x upside over the next 10, maybe 20 years as this vision plays out. I think this is going to be one of those companies you want to accumulate on these pullbacks, and this is a really big pullback, but a really good valuation for investors as well. By the way, Coinbase also has a phenomenal balance sheet. They could choose to buy back some of the debt that they have on the balance sheet as shares pull back, and they continue to generate cash from the business. So a lot to like about Coinbase in the future. Number 5 is Rocket Lab. Rocket Lab is not a stock that I bought yet, but again, shares have pulled back 42% from their high just a couple of months ago, and they just announced last week a $5.6 billion contract with the US Space Force. So they have a lot of momentum. This is basically a 2-horse race in the US right now in the rocket business. And this is the best way that investors can get exposure. This isn't the cheapest stock. I think we need to acknowledge that. $8.5 billion market cap. They're not generating positive net income at this point or positive free cash flow. Enterprise value to sales is almost 20. So very expensive stock. But if you think that there's a huge future in the rockets business, putting satellites into space, maybe potentially going to Mars, I think there's a ton of potential upside for Rocket Lab. And I think they've established themselves as a company that can compete with a leader like SpaceX. So a little bit more high risk for Rocket Lab, but the opportunity is there. And again, not a stock that I own yet, but I like that the pullback is giving us a little bit better price. And at the same time, the business is a little bit more solid because we have higher backlog as these contracts are signed. So the risk reward balance is starting to get a little bit better with Rocket Lab. Speaking of risk reward, let's go to stock number 6. That is a very low risk and a little bit lower reward opportunity in Verizon. Verizon is, as a telecommunications company. So your smartphone connections, they've also moved into 5G home wireless. That's a very competitive business, but they have a very compelling product. And this is a dividend yield story and a free cash flow story. Verizon pays a 6.3% dividend. So if you think the market is going to pull back in 2025 and there's going to be recession risks and consumers are going to spend less, one of the things they're not going to do is they're not going to cancel their cell phone bill. I think that gives Verizon a huge opportunity to be one of the safer stocks in the market. So you got some high risk stocks that I've talked about a little bit earlier. This is a little bit more on the safe side, not going to give you the same upside potential, but you are going to get a really nice dividend. Verizon is also a cash flow machine. The challenge for them is that they've spent a lot of their free cash flow on paying out dividends, maintaining that high dividend rate, and they continue to acquire companies like their recently announced acquisition of a fiber company. So now they're trying to go from a cell phone company to just a communications company with the fiber network. That was a pretty expensive buyout, but it is a good strategic move because it allows them to bundle more services together. I think the future for Verizon is ultimately going to be to bundle together your smartphone, your home internet, whether that's wireless or fiber, and your streaming services. I think all three of those things, that's like the new generation of the triple play. That's where I think they're going to ultimately have much more of a sticky business, but highly competitive business, hasn't done particularly well over the past decade or so, but you get a great dividend. So in the case of a market pullback, I want to have a little bit safer stock, and Verizon fills that need for investors. So there you go. 6 stocks that I talked about today: Alphabet, MGM, GM, Coinbase, Rocket Lab, and Verizon. Let me know what you think about that list. And of course, subscribe to Asymmetric Investing, my newsletter. I'm going to put out my official buys for the asymmetric portfolio on April 1st. And you can also follow the market beating portfolio. Like I said, beating the market in 2024 and also beating it so far in 2025. Looking to continue that streak. And the great thing is I'm buying some great stocks at much better prices. And that outperformance doesn't even include the one special situation short that is up 141%. But you can look at that in Asymmetric Portfolio. And of course, check out finchat.io/ASYM if you want access to the charts that you saw here today. Just a phenomenal tool for researching investments. But let me know what you think in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.